order, and we need a roll call attendance first.
All right, Ms. Forrester? Here. Ms. Cavanis?
Here.
Mr. Dirty?
Here.
Thank you. Ms. Smith?
Here.
Mr. Cromer?
Here.
Mr. Shoemaker?
Here.
Ms. Harris? Here. And Mr. Anderson?
Here.
Great, all present today.
Great. Pledge of Allegiance. Julie, you want to lead us?
Sure.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Okay, we will go on to item number 1, discussion and possible action resolution authorizing teleconference meetings. Is there any public comment on this item? Then I would entertain a motion to adopt.
So moved, Madam Chair.
I'll second.
Thank you. Any further discussion? Roll call vote. Judy?
Ms. Forrester?
No.
Ms. Cavanis?
Aye.
Mr. Dirty?
Yes.
Ms. Smith?
Yes.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris? Aye. And Mr. I'm sorry, Jim. Approved.
Thank you. So the item number 2 is the consent agenda. We have the minutes of the April 20th board meeting. We have the March and the April retirement reports, and we have the monthly financial reports. Any public comment on the consent agenda?
Not seeing public comment at this time.
Okay, thank you. So any, well, I guess we need any questions on the consent
Motion
agenda?
to approve consent.
Okay.
Second.
It's been moved and seconded to approve the consent calendar. So we need a roll call vote on that as well.
Ms. Forrester?
Yes.
Ms. Cavanis?
Yes.
Mr. Dirty?
Yes.
Ms. Smith?
Yes.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris? Aye. Approved.
Thank you. No agenda item number 3. So number 4 is discussion regarding the historical benefit review project status report and project update.
Thank you, Chair Smith, trustees. I have provided the May benefit correction report. This month's activity was entirely comprised of inactive interest corrections. This was the last group of them. So we did correct 504 accounts that were mostly terminated members, but there were a few inactive or active members in that group. And that should be the final piece of that item for the correction project. I think I included a new page to the report. Let me scroll all the way to the back and see if I added it.
Now.
Yeah. There's actually 2 new pages starting on page 87 and 88. One is a count of the corrections by the error number, so you could see how much had been completed on each specific type of error. Now, of course, some folks did have more than one specific error, which is why the total number of errors exceeds the number of people that I referenced in other sections of the report. The second page was a reconciliation of the number of members affected. That included terminated members. And if you have any questions on anything in the report, I'm happy to entertain your questions.
Any comments or questions from trustees?
just a comment. We had a closed session last time. I was surprised we didn't have one this time. I'd like to see us run with that each week, just so if we need an update or if there's any questions from the board by litigation, we can pose those. So again, it's a request to keep a closed session item on this project on the agenda.
Thank you.
If there are no further comments, we're going to move on to agenda item number 5, discussion and possible action regarding investment matters. And we have in person, live, Greg and Claire. Thank you for being here.
Yeah, it's so good to see you all. It's great to be here in person again. It's been a solid 2.25 years.
Oh, wow.
Since we sat in this room.
Wow.
And obviously a lot has happened over that time. And it was great to be here in person again. And we miss seeing you all. Yeah. And Hannah's on the line too.
Oh, hi,
So
Hannah.
we'll bring Hannah up next time. Hannah is actually working out of our Massachusetts office.
Oh, gosh.
Which is her parents' home. So she'll be back at the next meeting. So it's great to see you all. And so over the last 2.25 years, a lot has happened. And it's been an amazingly positive, cumulative time to be an investor. Now, a lot of that has changed since November.
Yes.
And we're going to look at some numbers here where absolute numbers look very grim on a year-to-date basis. But we want to keep in mind a couple things. One is we're performing in line with expectations of what a sell-off could do to the portfolio. We're still looking okay relative to other plans. None of the managers had problems. And if you look at our 2, 3, 5-year returns, they still look really good. But without question, since mid-November till today, I mean, we've had just kind of a standard market sell-off. And we're just, with the S&P 500 now, we're just getting to the point where it classifies as a bear market, down 20%. We're just getting to that point. And within our consulting team, one thing I was talking to the group about a week ago is a lot of times, traditionally these sell-offs are deeper and longer than we would think. And we're only 6 months into this. We're only down 20% for the large cap market. Small cap market's down 30-some%. So, it's been a bumpy ride to where we're at now, and I wouldn't be shocked if we have a few more bumps along the road. So we should be fully prepared for that. But we should keep in mind that our 3-year, 5-year numbers, our long time horizons are advantage. It still looks pretty darn good. One of the things that's been striking to me in this recent sell-off is that nothing has broken. So if you go back to the global financial crisis, if you go back to the Enron WorldCom days, things broke. The piping in the financial system broke. Housing broke. Asset-backed securities broke. This has been it's a sell-off. And that's it so far. There's the lasting damage we haven't seen that yet. And that's obviously a good thing. But we could have a little bit of ways to go. And I say that nothing broke really until last week with the crypto world, right? With coins that were supposed to be worth $1 forever, all of a sudden became worth 0. So a lot of times when things break, it's on the frontier of the investment world. It's where new things are being created, where there's leverage, where there's speculation, where there's no regulation. Think of the shadow banking system in 2008. That's what's going on in crypto right now. So one thing we should keep an eye on is make sure what's going on in crypto doesn't affect the rest of the capital markets. But in the grand scheme of things, right now, I think the Fed is getting 100% what they want to fight inflation by reducing support to the market, increasing discount rates, sucking liquidity out of the economy, and financial markets going down. And if it's an orderly sell-off, they're just going to continue to do what they're doing and increase interest rates to a point that it slows the economy enough to take out as much inflation as they can control. So they're getting what they want right now. Down 20% U.S. large cap stock market, it's not a problem. Not a problem for them. Right? So they're just going to continue to do what they're going to do to fight the bigger war, which right now for us is inflation. Now, you all take a look at, read the papers just like I do. And we all know that the Fed can't control certain aspects of inflation. They can't control supply chains. They can't control the war in Ukraine. They can't control that. But what they can do is control the aggregate demand that we have in the United States of trying to buy a finite set of goods being sold. So that's the one thing they can do, and they're going to continue to do it going forward. So a lot of grim numbers here, but in the grand scheme of things, it ain't that bad. It's merely a flush. Right? Some of you might have hyped up on me, but
I just need to interject for a moment. I'm getting messages that it's hard to hear.
should we move over
So,
here?
You certainly could move a little closer to the owl, and definitely we're gonna have to
Project.
project our voices. Yeah.
Okay.
You're welcome to move here.
Okay. All right. Thank you.
We tried to give you a view of the screen, which is why we put you down at
that's
that end of
great.
the table, and I expected a couple more
Yeah.
in-person attendees, but this is as far as we could move the owl to try to get.
Well, that's our assigned seats anyway.
Yes.
Yeah. Their initials are on the chair.
So with that, maybe we'll take a look. And Hannah, I think you were going to share your screen. Is that right, Hannah? We were going to look at our summary presentation. And on slide 3 here, we'll show the backdrop of what the capital markets looked like at the end of March. Lots happened since then. But you saw what's interesting here is that for the quarter, nearly all asset classes were down about the same amount. Call it 6%, 7% for US stocks, international stocks, and importantly, US bonds. This was the third worst quarter we've had in the US bond market in 40 years from a total return perspective. So everything down, the balloon is just getting a little smaller. Nothing popped. The balloon is just getting a little bit smaller. And so, okay, looking at this, we should expect for the quarter that balanced portfolios of stocks and bonds are down about 5 or 6%, just by looking at these numbers. And again, if you look at the long-term numbers here, we're giving up ground, but 3-year returns are still up 15% for large cap stocks, 10% for small cap stocks, and 5 to 7% for international stocks. So still a very good story over the long run. Flipping ahead to slide 5, please, Hannah. Here we're showing GDP, inflation, yields, and break-even inflation rates in the bond market. So these are kind of the underpinnings of macroeconomic factors which should impact the capital markets. Okay, so what about growth? Growth was actually negative in the first quarter. But if you dig into the numbers in the upper left-hand chart, GDP growth, if you dig into the numbers, one of the big things that made it negative was the fact that we imported a lot more things than we exported. And part of that had to do with unloading boats in Southern California. You know, things sitting off the shore, they finally came aboard on shore. They count as a import. And the way GDP works is you take everything we buy and sell, you subtract out things you import and you add things you export, and that's what the US GDP growth rate is. So if we import a lot of things, it comes out as a negative GDP number. It doesn't mean that we're not buying things. So that number can be a little bit misleading, and that number was a little better than it looked. On the upper right-hand chart here, we look at inflation, and this is the problem. Right? You see the hockey stick here, where inflation is up running 8.5%. And whereas a few quarters ago, we could say, well, inflation is confined to just one or two places. At the end of the quarter, it was running 4, 5, 6% in nearly every category. So it is a real issue that it is a real issue that you have to take a look at. On the bottom left-hand chart here, we look at yields for treasuries over different maturities. And the blue line is the yield at the end of March. So you see that blue line is a lot higher than the other lines. So we know there's been a big backup in interest rates because people expect the Federal Reserve to increase interest rates. And the short end of the curve moved up faster. Now, interestingly here, you'll see the short end is higher than the long end. And a lot of people have always said, well, that's a prediction of the market. There's going to be a recession. And so at the end of March, that's what was being priced in. Now, if you look at the market today, the yield curve doesn't look like that anymore. It's upward sloping all the way out to the 30-year, the 10-year spot. But this is the way it looked at the end of March. So one important thing here is you see interest rates went up, so we know bond returns are negative. But also where it went up is important on the short end, and your bond manager, PIMCO, had more money on the short end than the long end. So they underperformed for that reason. And then the bottom right-hand chart here, we look at break-even inflation rates. So what that is if you take an inflation-linked treasury bond and a normal treasury bond and you say, what's the difference? That's what the market is implying that inflation is going to average for the next 10 years. So one thing that jumps off the page here is that the market's not pricing in that inflation is going to be north of 3% on average for the next 10 years. So the market right here believes that the Fed is going to get it under control, that we're going to fix the supply chain problems, and inflation will revert back to something that's a little more normal. That's what is priced into the market. And if people believe differently, they could go borrow money, invest in one type of bond, short the other type of bond, and try to make money all day long doing it. They could try to arbitrage that if they really believe differently. So this is what's priced into the market right now. Market could be wrong, but this is what kind of on average is priced in right now. And on page 7, here's a different way to look at it. And this is the 5-year forward for the TIPS market. So what's priced into the TIPS market 5 years from now? What's the 5-year average inflation expectation priced into the market? And it's running about 2.5%. So the big bet on the market right now is that the Fed's going to be able to control this. Inflation is going to come back to something that's healthier, and that we're not going to have a prolonged recession. We could have a little dip, but not a prolonged recession. Let's start talking about the stock market. And here we start looking at on slide 8, Hannah, we start seeing the returns. So for the quarter, US stocks down about 5%. A couple big things jump off the page here. The first is look at the difference between that Russell 1000 growth and the Russell 3000 or the Russell 1000 value. So there's this huge dispersion in the quarter between growth stocks and value stocks. So the bigger sell-off is coming from stocks that are expected to grow in the future and may not have earnings today. Read technology, right? And that's because when interest rates go up, those kind of securities don't do as well because you're discounting all the future earnings. So really big sell-off in growth versus value. And when we look at your managers, that's going to jump off the page. Hey, why did the AB small cap growth portfolio not do well? Why did Europac not do well? And it's this right here, growth versus value, big shift. The other thing is on the 1-year returns, kind of jumps off to me. is that small cap stocks have been leading this sell-off. So you see the 1-year returns, small caps down, large cap is still up. So the average company is selling off more than the large company. And if you dig under the hood, you've got a few stalwarts in there that had yet to sell off and really hadn't start selling off until this month. And that's something like Apple and Microsoft. It's kind of funny that some people who invest in crypto might think of Apple as being safe money. Right? So you take some money out of crypto, you put it into Apple, and that's my safe money. Where it's still a stock that is trading at a multiple that's 25, 30 times earnings. So perhaps more to come on that front. Other thing for the quarter here is energy. You see energy on average is up 39%. We all know that's the price of oil. We haven't mentioned it yet, but in February, that's where Ukraine was invaded, price of oil went through the roof. And we started dealing with a new series of supply shocks. On page 10, we had the international equity portfolios. And here you see pretty broad sell-off across the board. A couple things jump off the page here. One, the tough returns for China and emerging markets. So emerging markets, think Ukraine, think Russia, think China. Now I think we showed some data to this for you, but Russia was actually a very small percent of the capital markets. It's about 1% of the international equity markets before the invasion. It's now 0%, right? But it was a relatively small component of the international equity capital markets before the invasion. So only about a 1% exposure. And then we have China here, and you guys listen to Kai Rizdal in the morning, NPR. Yeah, okay. Well, he had a great anecdote yesterday that Shanghai is under lockdown. Right? 25 million people live in Shanghai under lockdown. How many cars were sold in Shanghai last month? 25 million people. It's like all of New York and West. Zero. Not a single car was sold. So what does that mean for their economy, right? And so you started seeing that in the capital markets here during the quarter. The fixed income market on slide 11. What's been interesting here is that bonds and stocks have not diversified each other between November until the end of April. So stocks are down and bonds are down because both are going down for the same reason. Interest rates are going up to fighting inflation. And they're both selling off at the same time and to relatively equal amounts. Naturally, longer duration bonds have done worse. And up until the end of March, high yield bonds had actually not done terribly, right? Because the issue is not the economy, the issue is the interest rates going up. But in the last, let's say, 3 weeks, this relationship has changed, where bonds and stocks are starting to diversify each other again. Because before it was stocks are down because interest rates are down, because we're worried about inflation and increasing interest rates in the Fed. The last 3 weeks have been, I'm worried about growth going forward. I'm worried about economic growth now. So when the stocks go down, the bonds are actually going up in value now. And so that's a very healthy thing for the market to get back to. Yeah. And that's been going on in like just the last 3 weeks or so. So you like today, the stock market is down about 2%, at least as of 45 minutes ago. Who knows what it is right now? So the stock market is down and the bond market is doing well. So it kind of means, okay, people are taking money out of stocks, putting in safe haven bonds because they think the economy is going to slow. That seems to be the worry right now. And putting the bond market in context here on slide 12, it just shows you how bad of a bond market this was. This is historically bad. This is the third worst ever. And you'll see it's that little box that we have circled there. It's well outside of the bell curve of what you normally would expect the bond market to act like. And what's interesting is interest rates have gone up, but it hasn't been a shocking amount of increase. It's just that our starting point of value, the yields were so low right off the bat. One bright spot for your plan, and it's been great that you've been doing work in this area, is increasing your allocation to private real estate and infrastructure. So we've been mindful that our exposure to public markets is high, and in drawdown time periods like this, historically this plan has performed poorly relative to other plans. That didn't happen last quarter, actually. Your Claire will show that. Your performance ranking is kind of in the middle of the pack. And part of it has to do with the fact that you increased your allocation to private real estate and infrastructure. It's about 17% of the portfolio now. And here you'll see that real estate actually held up well in the quarter. It's not that there's, it's always going to grow to the sky here. We're not saying that, but it is diversifying. And so last quarter, real estate was actually up pretty meaningfully. Probably some lag valuations in here. So that's a little bit of the backdrop about what's been going on. One other thing I'll know, and I think we'll get to this with the monthly returns, is that the portfolio since the end of this quarter, it's the stock market's down another 10% since then, right? And the total return for the portfolio on an April basis is about as bad as it was for the first quarter. So just wanted to not acknowledge that as we're talking about the first quarter report. So Claire?
Great. So turning ahead to page 15, we start to take a look at what this meant for your portfolio. And I think Greg really hit on the majority of the highlights, but we want to see that concretely here. So if you look at the chart on the top of page 15, I always think this is a nice chart to help put where we are in the last quarter and kind of the sentiment that we feel in the market into context of the last 15 years. So returns are certainly negative. Some of them are strikingly negative. For the quarter, as Greg mentioned, the portfolio was down about 5%. That negative performance in terms of the total plan market value for your plan is captured in just that last segment on that top chart on the far right. So the plan was down in the quarter, but still has just about doubled in the last 15 years, and that's net of the outflows that pay benefits over that time period. So looking at the bottom chart, the plan finished the quarter as of March 31st with about $686 million in total. And here we show growth over the fiscal year to date time period. So the plan is down, the market value is down fiscal year to date to the tune of about $9.5 million. So that's investment losses of about $3.7 million and outflows of about $5.9 million. For the quarter, the negative returns, negative investment returns, translated to about $33 million in net investment losses. But again, in the context of the fiscal year to date time period, the strength of returns that we saw in the first half of the fiscal year to date, June through December, coupled with that $33 million investment loss in the recent quarter, meant about $3.7 million down for the total fiscal year to date. You can see in that net new investment column that a fair amount of money has moved around within the portfolio in the fiscal year to date time period. So that's a couple things. IFM, the second infrastructure manager that you allocated capital to, called that capital at the end of last year. That was about $17 million. And in addition to that, in the December-January time period, the portfolio was rebalanced. So money was taken out of equities, which had performed very well, and put into fixed income and real estate, because those two categories in the portfolio were underweight. Ultimately, that was a good policy move to stick to your policy target. Policy bands were breached, you rebalanced the portfolio. Robert rebalanced the portfolio. Given where we are today and what we've seen in the capital markets, that was certainly rewarded, sticking to your policy over that time period. Greg already mentioned this as well, but the decision to add infrastructure to the portfolio has certainly been rewarded. It's a short time period, but given the volatility that we've seen, having that diversification has benefited the portfolio. Looking at page 16, we see the actual asset allocation of the portfolio on the left compared to the strategic target, which is the pie chart on the right. And big takeaway here is that the portfolio remains in line with target. Again, back to the rebalancing exercise that was conducted at the end of last year, beginning of this year, to keep those two pie charts right in line. Real estate is slightly overweight as of the end of the quarter. That's because we've continued to see equity and fixed income sell off, and the real estate portfolio has produced positive. So no surprise there, but within policy. Page 17 looks at the detailed asset allocation of the portfolio as of March 31st. The balances with each asset category and investment manager, and the changes over just the last quarter. So on the previous slide, we looked at the fiscal year to date changes in the portfolio. This looks at just the last quarter. And at the very bottom of the page, under the investment return column, you can see that negative $33 million in investment losses for the quarter. So the portfolio finished the calendar year 2021 with $713 million, saw an investment return of negative $33 million in the quarter. That net new investment column says a positive inflow of about $6.5 million. That's a little bit misleading. If you look at that compared with the previous quarter, that's actually the activity of rebalancing into real estate. So a little bit of mismatching the way this kind of reports that money was pulled out of equity managers to fund real estate rebalance over the end of the last quarter, beginning of this quarter. In total, if you put those two quarters together, about $2 million left to plan per quarter to pay benefits, which is more consistent with what we would expect. And then finish the quarter with $686 million in total. Page 18 looks at the total fund performance. So performance for the total plan over cumulative or over annualized time periods. So on the far left, we see the last quarter. Portfolio was down 4.6%. The first quarter of the calendar year versus negative 3.2% for the strategic for the target. So underperformed slightly in the recent quarter, and we'll look at the drivers of that in a couple slides. For the last year, return is still positive, a positive 4.6% versus 7.5% for the target. Anything longer than that 1 year time period, all annualized time periods, 3, 5, 7, 10, 15, returns look very strong. And that's because the asset allocation decisions for this portfolio have benefited those longer time periods. Returns look strong versus both the strategic benchmark, but also versus the peer group, which is represented by the gray distribution. So that's other public plans. As Greg mentioned, for the recent quarter and year, the plans ranked about median within that peer group of other public plans. Pages 19 and 20 look at fiscal year returns. So on page 19 on the far left, we have the fiscal year to date return down just about 52 basis points. So as Greg mentioned again, given the huge swing that we've seen from the first half of the fiscal year in terms of what was happening in the capital markets to where we are now, it's been a bit of an emotional swing, but you put those together and the portfolio is actually only down about 52 basis points. Now, as Greg mentioned, we've continued to see negative returns through April. So at the end of the fiscal year, that could be more negative, but it's less dramatic than it might feel right now.
in a down market.
Yeah.
Yeah, I think that's great.
I'll skip ahead to page 23 to talk about a bit of the drivers of that relative performance. So here we look at attribution for the portfolio for the last year and also the longer 5-year time period. So looking at just the last year, the top half of the page, the portfolio was up about 4.6% for the year ended March 31st. That underperformed the target return of 7.5%. Circled in green is the manager effect. So that's the underperformance or outperformance of the investment managers collectively within each asset category. And then circled in red is the asset allocation effect. So that's going to be kind of friction in terms of the fact that you can't always be perfectly allocated to your target as asset categories move up and down. Circled in green, the manager effect, that's what drove the underperformance of the portfolio versus the strategic in the last 1-year time period. But there's kind of two key categories that drove that. The first is that your international equity portfolio did underperform. So collectively, the managers within the international equity portfolio underperformed the benchmark. In particular, your international small cap manager in the last quarter underperformed pretty dramatically. That pulled down the return for the last year. That's consistent with what we saw in the capital markets. So small cap was hit hardest, and if you had a growth bias, that was also a significant headwind, and that's true of your dedicated international small cap manager too. The other category that was a big driver within that manager effect is your infrastructure portfolio, which is a little bit confusing, but what drove that is actually the performance of the infrastructure portfolio versus the benchmark that's included in the strategic target. So that benchmark that you're using is actually a core open-end real estate, or not open-end, it's a real estate benchmark, the same benchmark that you use for your real estate portfolio. And your infrastructure portfolio was up, not as much as that benchmark. So there really isn't a perfect benchmark for the infrastructure portfolio. Over time, we think that is a reasonable benchmark over longer time periods, but that mismatch is what drove the quote-unquote underperformance of your infrastructure portfolio. Similar theme within the 5-year attribution at the bottom half of the page, underperformance of the international equity managers in total, and that mismatch of the private core infrastructure portfolio versus benchmark meant that the total portfolio underperformed its target. Still, actual return for the total portfolio is about 9.85% annualized over 5 years. That's great. The strategic target up just over 10%. Pages 24 and 25 look at all of the performance for each of the individual managers over both near-term and longer-term time periods. So on 24, we have the domestic equity portfolio. Every manager saw a negative return in the recent quarter. That's consistent with what we would expect. The numbers that stick out, or the one in particular, is AB US small cap growth. So again, small cap and growth were the hardest hit areas of the portfolio. That is generally consistent with what we would expect from that corner of the market. AB is fundamental bottom-up so they're stock pickers, and that's really what drove their underperformance in the recent quarter. Having a more kind of aggressive small cap growth companies in your portfolio was a headwind in the recent quarter. Now, over longer time periods, 3, 5, 7, 10, 15 years, that strategy has been rewarded. So it's just the shorter time period that has underperformed. Over longer time periods, they've outperformed their benchmark quite substantially. The other managers, active managers within the domestic equity portfolio, generally held up pretty well in the recent quarter and the market environment. Over longer time periods, no concern at all. Quite well and consistent with expectations. On page 25 are the managers in the remaining asset categories within the plan. So international equity, domestic fixed income, infrastructure, and real estate. Again, negative returns for the quarter and year out of all of your international equity managers and both of your fixed income managers. That's consistent with what we would expect. Within your international equity portfolio, the Euro-Pacific Growth Fund saw the largest headwind in the recent quarter, down about 12%, notably underperformed the benchmark. That growth orientation, which had benefited returns for quite a while within the portfolio and continue to show that benefit continues to show in the longer term returns for that strategy, that was a significant headwind in the recent quarter. So that drove their underperformance, just having that growth orientation. By contrast, Mondrian International, which had underperformed as growth had driven the market in previous market environments, really protected value well, so down just about 2.3% in the recent quarter, down 2% for the last year. So that strategy really diversifies some of the more aggressive exposure of the other international managers in that portfolio. Europac underperformed, Mondrian outperformed. That's a reversal of what we've seen when growth was leading the market. T. Rowe Price International Small Cap is really the strategy that stands out as the underperformer for the last quarter, down almost 18% for the quarter, brought their one-year return to negative 14%. Similar to what we saw in the domestic equity portfolio, the last one-year time period is pretty painful. Anything longer has done quite well. So even over 3 years, they're still ahead of benchmark, up about 11.5%. The growth orientation and the small cap orientation of that strategy were the significant headwinds to their performance. The other thing that stands out to me about T. Rowe's performance over 3 years is that having a dedicated small cap allocation within your international portfolio is out of benchmark. So you have a dedicated allocation there to small cap. Having exposure to that corner of the market has benefited the return for your international equity portfolio over time. So over 3 years, the total international equity portfolio is up about 7-8%, small cap up 11.5%. So on an absolute basis, that has contributed. Fixed income down about 5.7% for the quarter, 3.8% for the year. Your two managers, Dodge and Cox and PIMCO, collectively have protected value versus the Bloomberg index. Greg mentioned PIMCO did underperform in the recent quarter because of their curve positioning, so having an overweight exposure to the short end of the curve. Dodge and Cox protected value in the recent quarter, had a slightly shorter duration than the benchmark, and their bond selection also benefited over that time period. Anything longer than the last year, 3, 5, 7, 10, 15, the fixed income portfolio has continued to outperform the Bloomberg aggregate index. And then lastly, the infrastructure and real estate portfolios turned in positive returns for the quarter. So we mentioned the diversification benefit of having those allocations within the portfolio and the positive effect that your decision to allocate to infrastructure and increasing the total allocation of the portfolio to private markets has had in the recent period. Are there any questions on what we've covered so far? Manager performance.
Claire, how could infrastructure have made money or gone up since we invested in it?
I think the income component and the kind of lagged valuation of those private market components have benefited, not been as reactive to the capital markets in the recent time period.
I think the income component you mentioned is really, really important there. There continues to be money going in to those markets. It's hard to generalize what infrastructure is because there's so many different segments within. But some, there's a big energy component to it. So like pipelines, and naturally they're like and toll roads. So one thing about infrastructure that, you know, some of it is economically sensitive. It goes up and down in value when the economy goes up or down. But some of it is pretty stable too. Like you literally own an IFM portfolio, the Indiana Toll Road. So people are still driving up and down Route 90 between Cleveland and Chicago, and they're still paying their tolls. And so you make money on that. So you own that company as an operating company, it's still making money. And then the pipelines are also obviously with the price of oil going up. I wouldn't argue that they didn't mark up the portfolio 30% because the price of oil went up, right? But you know, those kind of couple components are also, you know, contributing factor there.
So you mentioned the lag in reporting, Claire. Are these actually December figures that we're seeing reported here in March, or?
No, I don't.
Okay,
No.
I just wondered when you were talking about a lag, if it actually was a significant lag in valuation.
So our reporting isn't bad, but I think we acknowledge that the like the core real estate portfolios, they have a cycle where they go through, and within their portfolios, they underwrite the properties like a quarter of the portfolios every quarter. So let's say they own this building, they'll underwrite and revalue this building on a periodic basis. So the lag is more like, well, when's the last time they actually underwrote this building? And they do it all within the year. So that's more of the lag. But if you had, but what we're showing you here is the NAV of the funds as of the end of March.
One thing you'll note in like the monthly report, sometimes oftentimes we'll report a flat return for a month if we don't have that updated data for the real estate or the infrastructure managers, and then update us.
Trustees on Zoom, do you have any questions or comments? Yes, Dan, I see your hand up.
So I have a question. I'm not sure if this is for Greg or not, but earlier you said that there's an expectation that the market, I guess the domestic index market might continue to be down for several more months as the Fed tries to combat inflation. When you say that, are you thinking like the next 2 more months? I'm thinking because 38% of our portfolio is in domestic stocks. Is it maybe 6 more months? I'm just trying to get an idea for how much longer they're thinking there's going to be this downward pressure on the stock market.
Well, really impossible and difficult to really know, obviously. I'm very humble with any comment on this, and also want to point out that we don't advise your portfolio change based on these comments, right? This is a low probability of being very right or very wrong. And so we don't want to make that quote unquote bet. Now, having said that, I think that kind of the nature of my comments were that, you know, I think the Fed is happy if financial conditions tighten, and that includes financial conditions includes the price of stocks and the price of bonds. If you're a company and you want to raise capital, it's harder for you to raise capital now because your stock price is down. Fed's okay with that. But the other comment I made, and perhaps it's what led it to sound a little more predictive, was when you look at equity market sell-offs, they tend to last like 12 months. You know, let's call it 9 to 15 months. And they tend to go from overvaluation to below value, average valuations. And where we're at today is we went from overpriced to PE in the US stock market right now is 20. That's kind of the average. If you look at the average over the last 10 years, we've been running at, on average, 19 to 20. And this is current PE, not forward PE. Forward PEs are a couple points lower. But that's where we've been on average for a while. So US large cap market hasn't really gotten to a point where it's like really cheap. And will we get there? Don't know. But just knowing, if you look at the last few bear markets, it's gone through fair value and it's been longer than 5 or 6 months. So I think we should just be prepared for this. Right? This very well could go another 6 months. It could get worse. But we were buyers of stocks. Actually, we were sellers of stocks because we were balanced, which was great. But we were in the stock market 12 months ago at a higher price. So we're in the stock market now with a lower price, and kind of makes sense that you maintain that. Was that a sufficient non-answer?
I think it gives good perspective. Thanks.
Any other comments?
I'm curious, when we looked, I guess, about a year ago for different investment opportunities like private equity, how would that have positioned us right now in the better or the worse had we chosen to go with private equity?
Well, specifically private equity would have looked more like your infrastructure on a one-year basis, if not a little higher. So if you had taken money out of stocks and put it into private equity, then your returns would have looked higher today. Yeah, but kind of a few things about that though. That's if you did a one-for-one swap. Private equity is not valued as frequently as infrastructure and real estate. It's less liquid. Some would say the valuations underneath those portfolios is also higher than in the other private markets. And if you would have put money in private equity, you probably would not have as much money in real estate and infrastructure right now too. So the decision probably would have been, okay, I'm only going to have 20% in illiquid assets. So if I put in 8% target to private equity, I've got to take some money out of real estate and infrastructure. So I share that because it's not like it's just a one-for-one decision. But yeah, in private equity right now, the NAVs in private equity look better than the public markets. I met with a high yield manager yesterday, and I thought some things they mentioned was interesting. One was they were talking about the private credit market. So instead of private equity, private bonds versus the public bond market. So private bonds versus public bonds. And what they mentioned is there's so much money going in the private credit market right now that companies that issue bonds are being rejected by the high yield market, saying, I don't like those terms, and at that price, I'm not going to buy it. So they're going to the private credit market because the private credit market has so much money going into it, and those managers only get paid if they put money to work. If they're going out and buying those lower quality, lower yielding bonds. So I share that because there's so much money going into that market right now. And, there could be some of that in the private equity market too. So that's an anecdote. Yeah, exactly.
So anything further? You're moving on?
Unless there's any questions, I think that's a good summary. We also have the April flash report. And as we've alluded to, the market continued to go down in April. So the total portfolio is down about 5.3% in April alone. So a similar return to what we saw in the first quarter. Just about in line with the total fund benchmark, which was down about 5.2%. And that brings the fiscal year to date return to negative 5.8%. So that's where we were as of the end of April. We've got about a month and a half left to go in the fiscal year. When we look at the returns for the investment managers, similar themes to what we saw in the first quarter. So the public equity and public fixed income managers and markets were down. Infrastructure and real estate currently show temporary flat returns, but not negative for the month of April. So that's, again, similar to what we saw in the first quarter in general. And then on a more granular level, similar themes, so small cap and growth continue to be hit hardest. Returns for any time period longer than that fiscal year to date, 1 year and 1 year time period remain firmly positive.
I hope we can say that 5 years from now. Comments, questions? Well, I always learn something new every time you present, and I'm just amazed at how you can break out the effects, like between the allocation versus the manager and all that. It's just beyond me. That's
Great.
great.
Great, yeah.
Anybody else? Well, thank you for coming in person.
Yes.
So good to see you.
Yeah.
So fun, yeah.
Yeah. When it's a.
All understand.
Well, I'm not gonna go that far.
I was in March at the, or that February.
So I made it to the offsite,
Okay,
but Claire couldn't make it and Hannah couldn't make it. to the
Right.
offsite. But, yeah. But I haven't been in here at this point. Good to see you.
Thank you, Hannah.
Thank you.
Thank you, Claire and Greg. Yeah, have a
thank you.
nice
Thank
drive
you.
home.
Yeah.
Because we've got strategic plan next, we'll take a 5-minute break.
I think we were hoping to get maybe a slightly longer break, so
Okay.
I can make sure, because we had told them we thought we might take them closer to 10. I'm emailing them right
Oh, okay.
now. So,
Okay.
yeah, 10, 15-minute break.
Okay, all right, we're going to move on to strategic plan after we get them online. So we're going to take a break while that happens. So let's at least take a 10-minute break and come back at 20 till 10, okay? And somebody.
thank you.
And are we on? And our next agenda item is number 6, discussion and possible action regarding the draft strategic plan. So we welcome Amy and Catherine back to us via Zoom. Good to see you.
Thank you, Madam Chair. Good to see you as well. I'm Amy McDuffie from Mosaic Governance Advisors, and with me, of course, is my colleague Catherine Jackson. So it's a pleasure to be here. We are coming back to the board today with the second reading of the draft strategic plan. And if you recall, we've had quite a journey to get to this point. We know the board has had a number of discussions, starting early this year, working through February at your offsite, where you spent about almost 2 days talking through the external environment and the changes going on there, as well as your internal operating environment and things that you saw as necessary to advance the future of MSERA. So we also know that in April, you had more good discussions around the objectives and some of the measures with Director Rentschler, and that there had been changes made by the board during that meeting. We did have subsequent conversations with Director Rentschler, and we incorporated the changes to the objectives that were discussed in your April meeting into the document that's before you today. The other thing that we did as a next step from the March meeting of the board, which was the last time that we had a conversation with the board, was to provide some new options for vision statements for the board to work through. And you may recall at the time that there was a lot of good discussion about the mission statement, talking about the core purpose of MSERA and getting centered on a statement that really reflected what you're delivering to your members, your retirees and beneficiaries and employers, and how. So the vision statements are the focus for today that we wanted to ask for the board's input and feedback on. The item itself has been agendized for possible action, but only to the extent that the board feels comfortable doing so. We want to make sure that the plan itself reflects the collective voice of the board and that it can serve as a dynamic filter for time and resources and projects going forward. So it has to meet that test. And we're guessing that that would be your test as well as you think about the document. So with that, I'm wondering, should I share my screen to show the strategic plan? Is that the best way to go about that, Madam Chair?
I believe that would be good.
Okay. Let's see if I can make that happen on my side. Well, let's try it again. Okay. Bear with me here. I'll refresh the page. Okay, hopefully everyone can see the draft strategic plan. And hopefully, thank you. Yeah, and hopefully you notice we also applied some graphic design to it too, so that it looks like a proper strategic plan document. We had the introduction, of course, and we provided a memo which outlines several of the vision statement options. So I'd like to go to the vision statement options, Madam Chair, if that's okay, and just kind of walk through that section briefly to tell you what we did, and then open it up for board questions on the vision statements. And then, of course, other areas of the strategic plan that you may have questions or comments about.
I think that's a plan. That sounds good.
Okay, terrific. So the vision statement options, what we did is using the mission statement as a pivot point, and the mission statement, of course, on the left-hand side of the document in green, providing sustainable pensions, retirement planning, education, and professional services to current and future members. So that was the mission statement that had consensus behind it at your March meeting. And you may recall what we noticed at the end of that March meeting was that the vision statement that we had was quite duplicative with some of the concepts that the board centered around with the mission statement. And so the mission statement that was the outcome, the vision statement that was the outcome of the March board discussion is also in green in the right-hand side of the page under the vision statement section. And so what we did is develop these additional options for you. And I also wanted to thank Director Rentschler because she provided some of the options herself. The question, of course, that we asked ourselves after going back through all of the sentiment analysis, the research that was undertaken prior to developing the SWOT analysis, so prior to the February offsite, as well as all of the outcomes of the discussions from the February offsite, is do the options provided answer the question, how will my life as a member or beneficiary of your plan be changed if you accomplish the goals of this strategic plan? So that was our focus point, and also to use words that we felt that your members might use in describing that. And so you see the options 1 through 5 that are listed here. And I'll just read through them briefly. To create a more, option 1, to create a more secure retirement for a better life. Option 2, to be a trusted partner in a more secure retirement. Option 3, to be a trusted partner in securing your retirement. Option 4, to be a trusted resource for your retirement journey. Option 5, to be a trusted resource for creating the retirement you've imagined. So those are the options that we brainstormed. But Madam Chair, I'll turn it back to you. I'd like to get the board's feedback. Is there one statement that resonates? Are there specific concepts that you don't favor? Maybe if we start there, we could see if there's a consensus around one of these options. Thank
Maybe
you.
could you bring the other members up? And Jerry has a comment first.
I would like to speak in favor of option 2. I think that it just seems to cover so much of what we're doing concisely and doesn't talk about you as a person, because the retirees are not, and our members are not the only people who are going to be looking at this. And it makes a lot of sense.
I might throw out, since I don't see any other hands right this second, I might throw out the terms partner versus resource, and whether we have a preference for one of those. Jim, I see your hand up.
I'll wait and just allow that question to be addressed.
Okay. I know, Jerry, you like the number 2, which says partner. I was kind of leaning toward resource before partner, so I think.
And I could go with that one too. I just don't want some of the other editorial.
you and your, yeah.
So like option 2, but just swapping out the one word.
Yeah.
I do like the shorter ones rather than the one in green that we had talked about in March. So, okay, Trustee Anderson and then Trustee Shoemaker.
And it sounds like you're narrowing down where I was going. The only one I was concerned about was option 5, because we don't know what people have imagined.
Yes.
Yeah.
But I do like the resource, because I think legally that's kind of all we can be. The partner, I think the partner is a fiduciary. Might suggest that that there's something beyond our legal boundaries that we can provide.
Okay. Think about, and then I'll get you, Richard. Think about substituting partner for resource, or the other way around, in option 3, resource. Anyway, Richard, comment.
So for what's on the board, option 2 minus the word more and change to resource, or I guess it's a play on 5, to be a trusted resource for a well-planned retirement. But I do not like the partnership part. I think we are a resource in the way society is now. Few people will get as many years in as Julie and Sherry have gotten. So we're only a resource.
You should do it, kids. Sign up.
Trustee Dirk.
I like where the discussion's going, and I like Richard's kind of modification of two, I think it is. I like resource more than partner, and I think what I like about all of these is none of them are really over promising that the pension by itself gets you the full, perfect retirement. It's because everybody's going to get the pension, everybody's going to get Social Security, and hopefully they've got something else in the works.
And it still may not be perfect. Coming from a retired person.
Yeah, you bet.
Richard, your hand's still up. Are you, have another comment? We can't hear you either. Okay. All
Madam
right.
Chair,
Yes.
I agree with the way the conversation's going. I don't like for, and mainly because of the word journey. I just don't like that word and that use there.
Mhm.
And 5, I agree with Trustee Anderson's comments about what they've imagined, because that's an ambiguous and undefinable term, and I don't like the contraction used there either. So I do like the suggestions that other trustees have made, though, as far as the resource.
So we've got the first 5 words, to be a trusted resource. What's the rest of it?
I like the rest of Richard's sentence, what he said. And I don't know if you can repeat that exactly, but it had to do with well-being.
Richard, can you
number 5.
repeat what you said?
Yeah, to be a trusted resource for a well-planned retirement.
Retirement. That's perfect.
There's a 4 there.
Because that well plan indicates that we will be available, we're intending to share more information about other options than just the county retirement. We're hoping to have some more education for them. I think that well planned, be a resource and well planned, I like that.
And resource and 4 kind of do go together. Partner in, but resource for.
Right,
Create-
they don't have to use this for that, but that's what we'd like them to. That goes to the education stuff we were talking about during strategic planning.
What about the word creating? Richard, you left that out of 5, to be a trusted resource for creating a well-planned retirement. Developing,
I hedge us being creators.
Okay.
I think that's an overreach for us to be that. We are a resource. We can give them info. We can, line it out, but we're not creating it.
my only question, I guess, is, and I'm not an English teacher, whether we need a verb in there.
What about option 2, which is sort of what Richard's saying with 5, but to be a trusted resource in a secure, well-planned retirement? That's kind of too much.
Yeah.
I would say that to be is our verb. We are to be.
There's more than one verb, but you probably have more English than I do. I don't know.
Madam Chair,
Yeah, go ahead, Amy.
I was just going to offer a couple of comments. I really like the direction that the discussion is headed. And I take the point, it's a very fair one about the word secure and maybe having a need for that. It's always interesting to me, regardless of which public pension fund we're working with, security is just one of those adjectives or qualities about pensions that is really attractive to members and beneficiaries. And oftentimes, when you conduct focus group research as to what they appreciate most, it is the security. Again, the vision statement is where you're headed. We use that word because a secure retirement also tags into the words that your members brought through on their side. Sustainable was a well-used word as well, and you can see sustainable in the mission. So I guess the question I have, and it took me a while to get there, but here's what it is. Do you think security is covered through the word sustainable in your mission? Is security tucked within that concept of sustainability? And is it sufficiently tucked under it enough such that you don't need it as part of the vision statement? And that would be the question I would just ask for the board to think about as well as you consider these very viable options that you have.
My immediate reaction is yes, that security is contained within the word sustainable, but I think it's also contained within the phrase well-planned. A well-planned retirement would be a secure retirement. So I'm not sure we would need secure, but I'll defer to others. I see Trustee Anderson. Jim? Did you put your hand down?
Yes.
Okay, Trustee Shoemaker.
It's interesting how you can kind of go deeper in these words. You know, in the one where it doesn't say create, it says a well-planned, and to me that's an implication that, you know, we're a resource and we're going to work with you, and you are going to well plan your retirement. And then it is actually our job to make it secure, not the member's job. So having the word secure in there, I think is different, but it has to me a slightly different meaning, and it is similar to sustainable. But I think if you went to the street, some people would say sustainable is jargon based in some things we see today, and secure is very understandable. So it makes it a simpler word. So, you know, again, to continue to modify kind of number 5, to be a resource, a trusted resource for a well-planned and secure retirement. And I think hopefully that might cover it all.
Yeah, I like the word secure because I think it addresses things that we tried to correct and work towards or address for our members, which is what we're seeing with the historical benefit review process. So we need to make sure that, you know, we don't go down that road again and we get the benefits stabilized so we don't find ourselves with the errors. And also, so secure there, and then secure in our investments, you know, in our returns and our decisions we make about the financial stability of the fund. So I think secure is an important word to keep in there, separate from having sustainability in a mission statement.
I liked Richard with the and in it rather than a comma secure. That just sounded wordy.
Yeah.
So Richard, I'm going to repeat it. You tell me if it's right. To be a trusted resource in a well-planned and secured retirement.
I use 4A rather than, yeah.
Okay, to be a trusted resource for a well-planned and secure retirement. Where are we, other trustees, with that?
I love it.
Yeah, I like it. Okay, I think, Amy and Catherine, that we have a consensus for that. I don't see any objection. So thank you, Richard, for the suggestion and everyone for the comments. I think it does portray what we want it to say.
Terrific. Thank you, Madam Chair and members of the board. I think this is a perfect landing spot. And we captured just one more time to be a trusted resource for a well-planned and secure retirement. Of course, with a hyphen between well and planned.
Yes.
Yes. So,
Was it a hyphen or an and?
sorry, a well-planned hyphen in the word well-planned, the words well.
Got it.
Mhm. Yeah, so what we will do is we'll modify this half of the page here under vision and take everything out and just leave this statement that you all just agreed to as the vision statement in green. And so that solves that aspect of the strategic plan. I did want to ask if there are any other questions, comments, thoughts on any other aspects of the strategic plan that's before you, whether that is about the document itself or the words or concepts expressed, or even if it's about implementation. We noticed that Director Rentschler provided a calendar that showed how some of the strategic plan objectives would be visible to the board through your discussions. And so we wanted to make sure that we have this as a stopping point in the discussion this morning as well, to see if there's any additional feedback to take on board.
Yes.
Mine's just a question, and I'm not even finding it right now, but we use the word threat. I'm sorry, it was late last night and my iPad was turned vertically and I couldn't turn it back. And possibly that was something that was discussed in the hour or two that I missed in the outside. But I would like at least some clarification of why we said threat instead of risk, and are these words interchangeable or are they not? And I can't even find where it was.
I'm looking for it.
I managed to turn my document upside down, so I don't know what button I hit and I don't know how to get it back. I was trying to search and find the word threat because I do know we use the word risk in several areas.
Yeah.
And I'm not actually coming up with that word in use. Amy, are you aware of where that might be?
Yes, I am, and thank you, Madam Chair, Director Rentschler. I think I know where that is. And in fact, it's right at the bottom of page 3. I'm gonna, I can't use my cursor, but it's the first paragraph under assessing priorities. And you can see in the second line from the end of the paragraph that starts opportunities and threats on the immediate and near-term horizon. So that's where that word came in. And I can give some insight into why we use that word. It is,
That's a SWOT.
yeah, because it's a traditional strategic planning exercise is referred to as a SWOT analysis: strengths, weaknesses, opportunities, and threats.
Teacher, we didn't
Yeah,
do
we
that
didn't
in
do
my
that.
days.
Yeah.
You didn't take the business management
Yeah,
classes.
no.
Yeah. Now, whether or not that's interchangeable, I think it likely is. I think you could say strengths, weaknesses, opportunities, and risks. I think you could do that. Catherine and I have often bantered about whether weaknesses is actually the right word, or is it challenges? So I think this is, again, this is your plan. And so we want it to resonate with you. If you think from an optic standpoint, threats might signal maybe more severity than you're intending, I could certainly see and be supportive of changing that word to risks completely.
Make a new acronym, strengths, challenges, opportunities, and risks. SCORE instead of
Or,
SWOT.
yeah, like that.
That's correct. Yeah.
Enlightenment with an E.
Yeah. Well, let me get some other
Yes.
comments and we'll come back to that.
And once you go to goal 2, it talks about risk oversight.
There's
And
a lot.
I think the only location where the word threat was used was sort of in that introductory paragraph about the assessment, which does really refer to what we refer to as the SWOT. But in goal 2 and other places that might have been in goal 4, in the objectives or the proposed actions, it did use the term risk.
Yes, and I really want to support the fact that risk has been brought up to such a high level.
I think a lot of people would recognize the SWOT acronym in that paragraph, but not everybody would. So if we want to change the words, we certainly could. Director Anderson.
Yes, can you hear?
Yes, we can hear, but there's some other noise, but not now.
Oh, I was trying to use my space bar, but I see that my mute was already off. I in this particular case, given that a SWOT analysis is so ingrained in strategic planning, I would recommend, at least in that paragraph, just leaving it. I think that the concerns are valid, that it could be misread unless you're familiar with strategic plans. But in this particular case, I would say leave it in. The initial reason I raised my hand, a little bit different subject, is I did want to give as I was reading it, give a thank you to both Mosaic and to staff. I'm really impressed with how well you listened to the board and were able to gel that into really succinct and well-written strategic plan. I even like just the layout of it and the look of it and so forth. There's a lot of information in there, easily read, concise, and I just wanted to say thank you and appreciate the work.
That was all Mosaic's work.
So I appreciate
Health
that.
Source Director Rentschler, we appreciated the partnership with you and your team on this, and thank you for the comment.
Love the grapes in assessing priorities.
That's
Yeah.
a nice graphic. Yes.
I was going to comment on how nice it looks as well. And one of the things that I see in this strategic plan that is different than previous strategic plans I've worked on is just the section in each goal of what will success for this goal look like. That I think is a fantastic addition to the strategic plan.
Mhm.
And Trustee Shoemaker, your hand is up again.
Well, I agree with Jim's comments. This is one of the best, to me, visually done planning document, strategic planning document, and the content is great. So, but back to this one paragraph, I would suggest we just simply eliminate strengths, weaknesses, opportunities, and threats, and let it read that could affect MSARA either positively or negatively on the immediate or near-term horizon were identified. And, I think probably 80% of people, well, 80% of the members, I won't say 80% of the members will read this, 80% of the members have no idea what a SWOT is. So I think just leaving that out, and I think you've done a good job with the leading comment and the closing comment for the lay reader to get the concept.
So you would take those two sentences and make it one sentence that says it also reviewed circumstances and trends externally within the broader business and social context that could affect MSARA either positively or negatively on the immediate and near-term horizon, or just strike the last sentence entirely? I wasn't sure if I heard you correctly. I don't know which you meant.
My comment was to remove the SWOT words and just make a sentence out of positive, negative, immediate, near term.
So it could affect MSARA positively, negatively, immediately, or in the near term, or something like that is what you, all right, well, we'll leave that up to Mosaic to turn into a sentence.
But Richard, if there's 80% that don't know what it is, there's going to be 20% that are going to say, didn't they do a SWOT analysis? You're supposed to do a SWOT analysis.
I don't find it divisive that it can't be included. So, I mean, I hear what Jerry's saying about the threat and that term and how that just seems scary, but I do think SWOT analysis is common. I don't think those words are offensive or divisive. I just say leave it as is.
Okay.
I think we're overthinking it.
What if you just put SWOT parentheses with SWOT after it, and would that assist?
You capitalize all four of those words.
Yeah.
I mean, I had one other, if I can, on a different topic, but I don't want to take us off this if we're not settled.
Well, I want to make sure that we're settled on this, because what Judy just recommended, I think would make a lot of sense to, in parentheses, put SWOT or SWOT analysis. I'm looking to Amy and Catherine to see if that would fit in. Richard, you okay with that? Okay. Okay.
Absolutely,
You-
Madam
I'm
Chair.
fine, I just want an explanation.
Okay. All right. I think that's what we want on that.
Terrific.
Okay,
Excellent.
okay. Now Julie, another topic.
On page 2, the last paragraph, it refers to our 700 million in assets, which we just.
Oh.
got 649.
Well, it was
Can we
700 million,
say-
and someday we hope to be back there.
Yeah, but if we just added in, upwards of, or,
Our many
being
millions,
at,
our many,
or-
many millions.
Yeah,
Yeah.
something more generic. I don't know, we peaked that at one point, but I don't know.
I think we're like 630 now or something.
How about,
649.
how about over half
I
a
meant-
billion? Half a
Exactly.
billion sounds big.
Yeah, yeah, I like that. Over half a million.
I don't know.
I mean, that was 1 month, right? So.
Yeah, it was like 2 months, we were over 700.
Boy, that allows for a lot of crash.
Not always, no.
Well, I don't know what it should say, but.
Yeah, Madam Chair, if I may,
Yes.
we could use
Upwards of.
more of a generic phrase over a half a billion. You could certainly do that, or we could take whatever the asset, and we'll look in your quarterly investment report and just drop a footnote and say as of X date.
I like that.
Okay, so,
650 million, and then in the bottom we'll say as of March 31st or April, whatever, I don't know.
Yeah, we'll use the date from, I know you just had your quarterly investment performance report, so we'll grab that figure and footnote it appropriately if that's all right with the board.
okay,
Okay.
thank you. Yes, Dan.
Just a question. I see several items. They have the target date and they have fiscal year 2023 or 2024. Normally, we would see that be with the 2 years in it, like fiscal year 23, 24. Maybe we don't need to change it for the report, but at least for clarification, could we just get, so we all know what that means? Does that mean fiscal year 23, 24 when it just says FY 2023?
And that was probably my notation. Yes, when I put fiscal year 24, I mean the fiscal year ending June 30, 2024. So that is the 23-24 fiscal year.
Right.
Should,
But we could put in the broader description, fiscal year 2023-2024, if you would prefer that. In all my notes, I just used the year in which the fiscal year ends to name my fiscal years.
I do that too.
Yeah, I agree with Dan's concept, 23, 24, 22, 23, et cetera.
so, I mean, this is getting picky, but would you have 4 digits on each of those? Or 2023-24, or how would you want that? Does it matter?
Plenty of room to do the whole thing. 2023 to 2024. And there's no question.
So is everything 23 and 24?
No, there's some stuff that goes on to 25, 26, 27, and some of the other goals. I had mentioned at the last meeting that I did shift a couple of things earlier into the plan, which looks like, again, like I was severely front loading it.
Yeah.
But the reason was that some of these items that will be handled in the first year or two will actually drive additional projects that I wanted to then fold into the remaining portion of this 5-year plan for the board's use. And that's why some of those dates have shifted around. And they may continue to shift because this is a living document when it comes to the work plan that will be presented.
Okay, so is it general consensus that we should have 2 years on each of those lines? Thumbs up? Okay, all right.
Okay. We'll make that change throughout, Madam Chair, so that the fiscal years are appropriately reflected as desired.
Thank you. Okay, trustees, other comments? We all. So given that our changes were fairly minor, if you're comfortable adopting it with the changes today, then I would entertain a motion to do so.
I would move to approve and request that if it could be sent out to us whenever it's finalized, but in advance of our next meeting, that way we could get it back to our respective boards to let people know about it.
Certainly. We can send out a final PDF after these changes are made and reflected.
So it has been moved by trustee Jurdy to adopt the strategic plan with the changes for today that we discussed today.
I'll second it.
Okay.
One.
Trustee Harris second. So any further discussion? Then we need a roll call vote. Oh, yes, where?
No, we have to ask for it.
Okay. Oh, I thought I did. Any further comments? Who is it?
So there's no public comment at this time. Thank you for letting me.
Okay, good deal. Okay, so roll call vote then.
Ms. Forrester, yes. Ms. Kapanen,
Yes.
Mr. Jurdy,
Yes.
Ms. Smith,
Yes.
Mr. Cromer,
Aye.
Mr. Shoemaker,
Aye.
Ms. Harris.
Aye.
Approved.
Thank you. And there's one more item under the strategic planning agenda category, and it is the 2022 annual strategic plan calendar. I don't know if Amy and Catherine are staying for that piece.
I just wanted to give a quick update. This version reflects the changes, I believe requested by trustee Shoemaker to include more information on education and training events. So this calendar now includes a separate column for that. I just wanted to point out that items with a bullet point dot are in-house training items that occurred during a regular board meeting. I provided the amount of credit hours, and then the ones with the diamond shape and dates reflect conferences that we typically participate in through industry groups. So I just wanted to show this to trustee Shoemaker and the rest of the board as far as that additional information.
And I see that today, May 18th, no, it says it has the Sacker Spring Conference. That was last week. Okay. Gotcha.
Because that was tied into the month of May.
This
Right.
month, yeah. Okay. Questions, comments on the calendar? Julie?
In the consent and routine matters, I noticed, having been here these last few years, that the policies are set to review, I believe, every 3 years automatically. So I was wondering if we went through our policies and put them in this calendar so people would understand when they're coming up for review again ahead of time.
Sure. Of the routine and operational, I think that the wording might have been changed, but that's true. A lot of the consent calendar items, I can certainly add specific policies as we expect them to come up, because we have a whole calendar for that we track. Similar to if you look at the March meeting, it actually did have a couple of policies noted. I stuck those policies under the governance and oversight because they had to do with charters. But I'll flesh that out.
Okay, thank you. That's good. This is helpful. Thank you. Other comments? Well, we would really like to thank Mosaic and Amy and Catherine specifically for all your work and how well you were able to pull our crazy thoughts into a document that makes sense. And we really appreciate the work that you've done.
Thank you, Madam Chair. It was a true pleasure to work with the board and the staff, and we're glad to be able to capture your comments and to do so in the way that met your satisfaction. So we really appreciate the opportunity, and we know that there's going to be really good effort and movement for MSERA under the strategic plan. So it was our pleasure, and thanks again for the opportunity.
And maybe we'll see you again in 3 or 4 or 5 years, who knows?
That would be a delight. So thank you.
Well, thank
Okay.
you.
Take care, everybody.
Thank you.
I think we
Bye-bye.
could move right on. I don't.
Okay. I thought you were saying something. Okay, well, moving right along, then we have agenda item 7, which is the fiscal year 2022, which is, Richard, the 2021-2022 quarterly budget update. And Director Rinschler, or is this Robert?
I'm going to refer this one to Robert, the quarterly budget update for the 3rd quarter of fiscal year 22.
Good morning, trustees. You have before you the quarterly budget update. As typical, you've also got a memo where I tried to get into some detail. I'd be happy to answer any questions you might have.
And I might also ask if at this time, if there's any public comment. I forgot to ask that on this item. So comments from public or from trustees.
There's no public comment.
Director Anderson.
Yeah, I'd just like to say that Robert's had some detail. He always provides great detail to the point where when you get to the line item budget, it's very clear. And I just wanted to say how much I appreciate Robert's efforts there.
Agreed. Thank you, Robert, for all of the work you do.
Thank you. You know, I could briefly run over of just a few big line items if you'd like.
Give us 1 second. I think we had a comment from Trustee Harris here, and that way we can make sure your answer incorporates her item.
Well, it may be a little off track, but it talks about our vacant board position, and I was wondering if there is any update, Dan or Doris, that you're aware of as far as getting a new member.
Well, how many people have you harassed to join the board?
I haven't.
No, we haven't seen anybody yet.
Yeah, it is out there on the county's website as far as an open board position, and there has not been a lot of activity on that. You know, part of our strategic plan includes some succession planning for the board. So, I will eventually be asking all of you to come up with some suggestions of people who might be good fits for the board. But if you have any individuals you think might be a good choice for serving on the board, please go ahead and encourage them, or put out their name to me, or have them contact me. I'm happy to give them more information about the board and the experience here. But at this point, no, we don't really have any update to give you.
Do you want to hear more details from Robert, or would you rather go on and talk about the budget for 2023?
We have an amendment, which item also, which we'll go into next time.
If that's okay with you, Robert, we'd rather talk about next year. So let's move on from item 7.
Yeah. Do we have to approve the amendment?
We aren't there
The
yet.
amendment is a separate
It's coming.
number.
8. So agenda item number 8, discussion and possible action regarding the fiscal year 2022 budget amendment. So this one,
Also goes to Robert.
okay, Robert, if you would like to address agenda item number 8, that would be wonderful.
Trustees, before you have the proposed budget amendment. It's a single line item to increase the technology expense. As detailed in the memo, the amount of work that we've been doing within the PG environment has exceeded what we had planned in the budget. And so this is it's sort of a two-piece amendment combined together. You may have noticed that in the budget report that we were not terribly over budget on the LRS line item. And so this is about $12,000 more above and beyond where we were last quarter. So the two parts of it is an additional additional funds for the fourth quarter, which we basically are expecting to have somewhere around 25 hours. We're expecting to need approximately 25 hours additional in work to complete some of the projects that we have in the queue, which include largely the benefit payment option number 4 and new employer contribution codes. That's related to payroll adjustments that are happening within the system right now, within the plan sponsor system, specifically at the county. And so the original 15 hours are per month are still there, and we're proposing to add another 26 hours each month. So that's
I'm sorry, is that right? 26 hours each month additional on top of the 15?
Yeah. So in total, it puts our budget for technology at about $192,000 for this fiscal year. And you may have also looked at the proposed budget for next year, which only comes in at about $190,000. So we're overshooting this year, hopefully slightly. The option 4 is going to be the largest chunk of that in our guess. And we hope to get that done at least in the next 2 months.
We're actually testing the option 4. We have a couple of little minor tweaks, but we're fairly close to being able to roll out that in production.
Good, good. So my only question, Robert, and you always do a great job in the explanations, but I got confused on the cover memo here. It says the budget amendment totals $20,400. Is that the amount that we're increasing the budget? Okay, and it says it's below the statutory limit, but it says it's 77,000 greater than the limit specified by the board in policy. And I'm just trying to understand what that means. 20,000, it can't be 70,000 over something, can it?
Well, that's in reference to the total budget. So if you look at the second page that shows the reports, if you look all the way down to the bottom section where we compare the overall administrative budget to the policy and the SERL limit, that's what that is referencing. And that actually hasn't changed because the technology line items are below the administrative subtotals.
Okay.
So that's really more for just completeness of the memo, I suppose. It doesn't actually change the previous approved budget.
And, you know, he references in areas hours and in other places dollars, just for your reference. The budget is $150 per hour for service from LRS.
Okay. Okay, thank you. Other comments or questions regarding the budget amendment of $20,400 to technology?
Mine was just on the memo date.
December. We were planning on bringing this to the board a little bit earlier. My apologies for not catching that. Do you see that, Robert?
Oh, I do.
My apologies. We can post an updated memo. This obviously was for the May 18th, 2022 meeting, and
I didn't even
probably the same memo that was used in the December budget amendment request, which is copied and then I imagine that happened.
Yes, those things happen.
Yeah.
Okay. So if I could have a motion for adopting this budget amendment as presented.
So moved.
Okay. Got a motion. I need a second.
I'll second.
I don't know who said that, but Richard maybe. Okay, so we have
Who
a.
was the second motion?
It was Trustee Anderson.
Thank you.
wait, can he vote today? But he can make a motion.
You can make a motion.
Okay.
You don't get to vote, but you can make a motion.
Wanted to do something.
Yeah, there you go. Any further comments or questions? A roll call vote.
Ms. Forrester? Ms. Cavanagh?
Yes.
Mr. Jurdy?
Yes.
Ms. Smith?
Yes.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris? Aye.
Approved. Thank you. So we will move on to agenda item 9, which is discussion and possible action regarding the proposed fiscal year 2023 budget. And this, thank you, Robert, for sending that out a few days ahead of the meeting. That was very helpful because it is quite a lot to take in. So we appreciate that. So
Thank you, Madam Chair. I will be turning this over to Robert in just a moment. I did want to just mention that we had sent out the draft budget a couple of weeks before this meeting to give trustees an opportunity to look it over and get back to us with any comments. We had not received any comments from trustees. The budget as provided, Robert provides a nice narrative and some comparison figures, and I'm going to turn the rest of the discussion over to him.
Okay, Robert.
Trustees, yep, you have before you the proposed budget. And like Dor said, we hadn't heard anything back on any proposed changes or concerns. And so I just wanted to open that up for discussion right now and ask again, were there anything that jumps out or any questions or comments that any of the trustees had?
I don't have anything in particular about the budget, but I was wondering about the, I guess it's 21 basis points board policy for the budget and how we are, I think, $19,000 short of that limit in the budget. And Robert, correct me if I'm wrong. That, where did that come from? Where did that 0.21 come from? And do we need to examine that in the future?
Robert, if you don't mind, I'll take this one.
Yeah.
In the county employees retirement law, it allows plans to have an administrative budget exclusive of technology and investment management expense that can be $2 million or 21 basis points of your unfunded liability. The board here adopted a policy saying they wanted to use the 21 basis points, which has kept us well below the $2 million limit. Now, as our unfunded liability, or excuse me, it's not the unfunded liability, it's the actuarial accrued liability. As our liabilities increase, the 21 basis points would eventually increase to be more than $2 million. Right now, we're hovering right around where 21 basis points is a little bit less than $2 million, but our budget is still less than $2 million. That's an option in code that says your budget can't be more than the greater of those two numbers. So right now, the greater of those two numbers is $2 million for us. And eventually, we will likely see that the 21 basis points of the accrued liability becomes the maximum administrative budget that we would be allowed under the CIRA.
Trustee Jurdy.
Yeah, this is kind of a small item, but the county is shifting over to Microsoft Outlook away from Novell GroupWise. And I'm just kind of curious how that's working for MSERA staff.
It's a little bit of a mixed bag. There's a little bit of a learning curve there to find how to reset up your email groups and things like that. But overall, the transition has not been too terrible. It's gone relatively smoothly. What do you think, Dan?
Dan, how's it going with the county?
Well, I think I've heard similar comments. I mean, personally, it's been more than about 10 years since I used Outlook. So I'm just getting reacquainted with it. But, it certainly does a lot more than Novell GroupWise did. And I was having, lots of glitches using a personal laptop and trying to access it remotely, not from a county computer, but from my own personal computer. So it seems to be much more seamless for people who are accessing their email remotely. But yeah, there's definitely some learning curve, and I did appreciate the fact that IT had extra staff on the weekend when the transition took place, so they could receive calls and answer questions and help people log in from their devices. But generally, I think there's a lot in the Office 365 suite that I have a feeling that, you know, even a year or two from now, we're still going to be learning some of the tools that it offers.
Trustee Anderson?
Thank you. This is going back to the earlier question from Trustee Forrester. Just real quick historical perspective, the 21/100ths of the accrued actuarial liability that's in the SERL. There was a point post 2007, 2008 where small systems were having difficulty with their operational expenses, and the legislature changed it to, you know, the $2 million or the 21/100ths, and it provided kind of an operating cushion for the smaller systems. And Sarah's board at that time, if I'm remembering this correctly, and Richard, if anyone else wants to jump in, is that with, you know, less than $300 million in assets, there was a fear that we would overspend what may be appropriate at the time. And so it was kind of like this built-in, you know, don't pass the 21/100ths of the AAL, but at the same time legally you can go up to the 2 million. The board may want to at some point address whether or not that's still a necessary budgetary policy. I'm not recommending it today, but you may want to revisit that.
Other comments or anything in particular, Robert, that you wanted to highlight that you didn't in your memo?
Well, I don't know that there's anything I didn't mention in the memo. You know, I guess I would remind trustees that the personnel section includes a fully staffed department. The legal line item expense also has been lowered to be more in line with what we've seen over the past 2 years. That's probably the other big change there. And you know, the investment subsection, we do have what has been fairly typical growth estimates for our managers, but the NAVs that were used were February, March NAVs, which, as we heard earlier and which you're aware, were quite a bit lower than they had been in the past. So there's still some room for growth there. It is below the administrative line, so it doesn't impact the policy, the administrative budget limit policy amounts. But I just wanted to mention that as well.
Hey, Robert, I do have a request for future budget memos. If you reference the statutory cap, could you go ahead and throw in the serial section so if somebody wanted to look it up, they'd know where to go?
Yeah.
Great, thanks.
Yeah.
Well, if there are no further, oops, I'm sorry, Trustee Anderson. Question, comment? No question, comment. Okay. If there are no further questions or comments, we would need a motion to adopt the 2023 fiscal year budget as presented. Public comment?
If I may, we should just make sure there's no public comment.
Okay. Is there any public comments on the fiscal year budget? Is that you, Doris?
Yeah, that's so I can look at it.
There's no public comment.
Okay, thank you. So we do need a motion then. One way or the other.
I'll move to adopt the fiscal year 2023 proposed budget as presented.
Thank you, Julie. Catherine, second? Okay. So it's been moved and seconded to adopt the fiscal year 2023 budget as presented. Any further conversation on this topic? Then Judy, would you do a roll call vote?
Ms. Forrester?
Yes.
Ms. Kavner?
Yes.
Mr. Jurdy?
Yes.
Ms. Smith?
Yes.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris? Aye. Approved.
I can't say the ayes have it because some of us are yes. You haven't taught us well enough.
It's spreading.
Yeah. I did it for a while, anyway. I try. And sometimes I call people by their first name and sometimes I remember that you're trustees, so I'm working on it.
You do great, Kathy.
Continuous improvement.
You can call it whatever you.
Okay. So moving on to agenda item number 10, and there is a related agenda item number 11. So the explanation, I assume, will be the same, but discussion and possible action regarding resolution 2022-10, defining compensation earnable pursuant to Government Code Section 31461 for members who are not subject to Government Code Section 7522.34, non-PEPRA members. And I probably should remember to ask if there's any public comment on this item.
There is no public comment.
Okay, so Director Rentschler.
Thank you, Madam Chair. There is a resolution to include two new pay codes, Code 387 and Code 510, which are County of Mendocino codes, as non-pensionable. Code 387 is a retroactive correction code used to correct for the paid California supplemental paid sick leave program. Code 510 is new though, and that would be an incentive payment for new hires to the Sheriff's Department as Sheriff Deputy Officers 1 or 2. That payment is described in the memo as a one-time bonus payment for Deputy Sheriff 2, which is a lateral peace officer, or a lower one-time bonus payment for a Deputy Sheriff 1 who is an academy graduate. So these are incentive payments to help recruit deputy sheriff's officers. This pay is not part of the normal compensation, and the recommendation is that both of these pays are non-pensionable.
Any questions or comments? Then we would need a motion to adopt this resolution.
Madam Chair, I'll make a motion to adopt resolution 2022-10 as presented.
Second.
Thank you, Trustees Cromer and Harris. Any further conversation on this topic? Then roll call vote, please, Judy.
Ms. Forrester? Yes. Ms. Kavner?
Yes.
Mr. Jurdy?
Yes.
Ms. Smith?
Aye.
Mr. Cromer?
Aye.
Mr. Shoemaker?
Aye.
Ms. Harris? Aye. Approved.
Thank you. Moving on to agenda item 11, similar resolution dealing with PEPRA members. Anything further to say?
No further comments on this except that it was for the PEPRA members.
Okay. Any public comment on this resolution for PEPRA members?
There's no public comment.
So I need a motion to adopt this resolution, 2022-11.
So moved, Madam Chair, as presented.
Thank you.
Second.
Judy beat you. Okay, any further comments or questions? Hearing none, we need a roll call vote on resolution 2022-11.
Ms. Forrester? Aye. Ms. Kavner?
Aye.
Mr. Dirty?
Aye.
Ms. Smith?
Aye.
Mr. Kromer?
Aye.
Mr. Shoemaker?
Oh.
And Ms. Harris?
Rule breaker.
Aye, almost, almost. So approved.
You ruined it, Richard. Thank you, everyone. So discussion regarding the administrative report. So I will turn it over to Director Rensler.
Thank you. As you may have noticed, for those of you who came to last month's meeting, when you came in, we had less staff than last month. Both of our retirement specialist ones that were hired had to leave. One left to take care of a family matter, and the other returned to the department for a position that better aligned with her education and background. So we will once again be hiring for the 2 retirement specialist 1 positions, and we currently have a recruitment open and ongoing. That should close in another 2 weeks, 1 week. And we'll then start the process for evaluating candidates. I did want to mention that some updated information on the voluntary correction plan that came in after the board memo was prepared is that we did receive confirmation from the Internal Revenue Service to grant our extension request that we filed in April, and I wanted just to let all of the trustees know about that. I also gave a presentation on the Historical Benefit Review Project to the AMCRE meeting. This was a meeting of both of their management group and actual members, and fielded questions. There were not that many questions for members present. A similar update on what was discussed at the AMCRE presentation ran in the May newsletter, if you saw that. I am working with the county on getting some additional information on their cybersecurity practices. They're in the process of conducting a cyber audit now and have agreed to share that information with our board in closed session. That would allow us to build off of the work that they've done at the county level to review MSARA specific practices, and I am working on getting quotes for services. I have a couple of quotes to approach a review of MSARA's practices already. Additionally, the strategic plan talked about internal audit services, and I have started some work on defining the scope for what we would want for potentially internal audit so we can determine the feasibility of a program such as that. And I do expect to issue the request for quotes for IT consultant for an IT roadmap, a 5-year IT plan, probably July 1 or around that time frame. And there's a mention here about our conversion at the county level to using Office 365, which includes Outlooks and Teams. And this will facilitate use of the county email addresses for trustees via Outlook, which you could access from any device as opposed to some of the issues that people had with GroupWise. So there is also a SACR's legislative update report for the board's entertainment. And if you have any questions, I'm happy to address any questions you may have.
So I did want to add a little bit to the Office 365 and Outlook transition. We do plan on having all trustees transition with us because GroupWise is no longer going to be active. We'll need to make sure that Outlook gets added to your county device if you're already working with the county. Of course, you have that ability already. But for those of you that serve us that are not county employees, we'll need to make arrangements to get Outlook on your iPads.
They could actually just use the web browser and go to outlook.com, and it would still allow them to log in, even if you didn't have the icon application, but we can give you an icon.
A web-based application, so you can log into it from any computer anywhere. But we do need to set up your password and 2-factor authentication, which is a security feature. So I do have IS staff getting prepared to assist you with that. Was hoping to have someone here today, but we may need to get the iPads in to IS to help assist you with that.
So you can
That
have just
also
an
means
icon.
that you'll be graduating away from using your personal email account for board business and going to using your county email.
And we forward the county email to our personal. That's gonna be,
Well, we'll have to find out.
we'll have to.
I don't care.
Okay.
Authorization.
Director Anderson, or
Just a,
trustee
yes.
Anderson. Yeah.
Jim works. Just to clarify, if our home computers do have Outlook application, can they still be used?
Yes, you can access your email once we get you transitioned over to Outlook from any computer, any device, your phone, your home PC, your laptop, whatever. You just have to go to the Outlook website. On the iPads, we can actually create a little icon so you don't have to type in outlook.com. But yes, you would have access to that once we finish the transition and get the county addresses moved over to Outlook for our trustees from anything. But it will require a two-factor authentication. Last night, I used my personal laptop at home to get into email. I didn't have to remote into the county servers or VPN or any of that. I just went and did my email, used my two-factor authentication, and was able to access my work email on my home device.
Every time, two-factor authorization, every time.
If you're not on a county device, the two-factor authentication would be required each login, is my understanding.
Thank you.
Items are just on the internet anyway, unless we have a closed session. So you can get that just by going to the website
Yes,
without
just
using your email. But
the
closed
email
session.
to know when Judy sends us something. I never.
Okay, could I ask about the recruitment that you had before for the two positions? Was there a good response list that you were able to interview against? Does that still exist, or?
We had, I believe, about 10 candidates, and we interviewed virtually everybody on the list. Several who were good candidates by the time we had interviewed them and then made a decision, offered the position, had already accepted county positions. Many of the people who applied to the last recruitment were actually already county employees. We did have a few from the general public who applied. Kayla was one of those when we hired her on. It was unfortunate that she had to leave to take care of a family matter. The recruitment is open now. We've left the recruitment open for a 3-week period instead of a 2-week period. And at this point, we won't know how successful that recruitment is until HR gives us a list. We have no idea how many people may have applied.
It seems pretty competitive out there. There's a lot of other positions available. So most of our applicants have been applying for other positions. And if we can't act quickly enough, we might lose candidates. Salary is a little concern, challenge.
Other comments or questions for Director?
What is the salary range?
Well,
Or that's not something that should be out there publicly?
no, it's actually publicly available on the county's website because the listing lists the salary range. Of course, there would be the capacity to bring someone in, maybe even as a retirement specialist too, if they had some desirable skills. The recruitment, I think, was shown as a specialist 1. And if you give me just a sec, I will get the.
Starts at 21.15, I believe, with the additional 5% confidential premium.
So it's 5% on top of that, or just that number?
5% on top of that. we would expect them to promote to a retirement specialist two within 1 year. Yeah, so Robert's telling me $21 to $25 plus the 5% confidential premium.
And-
There's 1 through 5 steps.
The current pay ranges for all of those specialists were just modified in 21 when the county finished their review of our positions here, and all of our specialists, the pay went up. And that's also when we added the analyst position. But the county just reviewed those salaries as part of that reclassification study.
Yes, Jim, question?
Quick to make sure I understand. I know you said that the specialist one would be expected if they're successful within a year to be a specialist two. Is the salary that you quoted the entry level? Is that a step? So if they stayed a one, they would have 4 step increases?
Yes, the annual salary for a retirement specialist one ranges from 43,971 to 53,456. And then the specialist two overlaps that a little bit, starting at a slightly higher and then ending at a slightly higher rate. And same with the specialist three. So that is the annual salary range for the 5 steps, from the 43,000 to the 53,000.
Thank you.
And we could potentially bring someone in at step 2 or something else, depending on skills or whatever.
Someone who could stay more than a month.
Mm-hmm. Any further questions? And I believe we will go on to agenda item 13, general board member discussion. And I just want to announce there that I did send an email. I hope you all got it, with the evaluation form for our executive director that is due on June 3rd. And I do need the time to summarize those, so get those to me as soon as you can by June 3rd, definitely. And if you didn't get it, let me know. Any other board member comments?
I have a question for Julie. Are you with us for another meeting or two?
I will be here for the June meeting. I don't know after that.
But you'll have to let us know.
Yeah,
To give you a farewell.
I'm staying as long as I can. Good, but definitely not past mid-August. So I can say that for sure. But so we'll see. At this point, we'll say mid-August.
Super. Any further comments? Then we will say.
Julie, I retired in February of 21 and I'm still working, so good luck.
Thank you.
The next meeting of the Board of Retirement is Wednesday, June 15th, 2022 at 8:30 a.m. It will be both in person and on Zoom. So we will see you then. Meeting is adjourned. No? We can mention it now.